The truth about index funds and ETFs. Hey, they're moneymakers. Welcome back to the Wealth Wizards, where we dive deep into the world of personal finance, investing, and everything money. If you're new here, hit that subscribe button and the bell icon to stay in the loop with our latest content. And if you're a returning viewer, you know we love having you here. Today, we're going to pull back the curtain and reveal the truth about index funds and ETFs. Are they really the game-changing investment vehicles they're made out to be? Or is there something the financial industry isn't telling you? You'll want to stick around for this one because we've got the facts and the details that'll make you question everything you thought you knew about investing. So, grab a cup of coffee or tea, sit back, and let's dive in. Introduction to Index Funds and ETFs. Alright, before we dig into the juicy stuff, let's start with a quick refresher on what index funds and ETFs actually are. An index fund is a type of mutual fund or exchange-traded fund, ETF, designed to track the performance of a specific market index, such as the S&P 500 or the Nasdaq Composite. This means that when you invest in an index fund, you're essentially investing in a broad range of stocks, bonds, or other assets that make up that particular index. Now, ETFs, or exchange-traded funds, are similar to index funds in that they track a specific index. The key difference is that ETFs trade like individual stocks on an exchange, which means you can buy and sell them throughout the trading day, unlike index funds that are bought and sold only at the end of the day at their net asset value, NAV. The pros of index funds and ETFs. Now that we're all on the same page, let's talk about why these investment vehicles have become so popular in recent years. There are a few key reasons. Diversification. When you invest in an index fund or ETF, you're investing in a large basket of assets. This diversification helps spread your risk, making it less likely that your entire investment will be wiped out if one company or sector performs poorly. Low cost. One of the biggest advantages of index funds and ETFs is their low cost. Because they simply aim to replicate the performance of an index, they don't require expensive portfolio managers to pick and choose individual investments. This means lower fees for you, the investor, which can translate into higher returns over time. Passive management. Unlike actively managed funds, where portfolio managers try to beat the market by picking individual stocks, index funds and ETFs are passively managed. This means they require less research, trading, and oversight, which also contributes to their lower costs. The truth about performance. Now, let's get to the heart of the matter: performance. Critics of index funds and ETFs argue that these investments can't outperform actively managed funds. And while it's true that some actively managed funds do outperform their benchmarks, the overwhelming majority do not. According to a 2021 study by S&P Dow Jones Indices, over a 15-year period, more than 88% of U.S. large-cap funds, 89% of mid-cap funds, and 88% of small-cap funds underperformed their benchmarks. That's right, folks. Over a long-term horizon, the majority of actively managed funds fail to beat their benchmark indices. The takeaway here is that, on average, index funds and ETFs tend to perform better than actively managed funds, especially when you factor in their lower fees. The truth about tax efficiency. Alright, we've tackled performance, but what about tax efficiency? This is another area where index funds and ETFs shine. Because index funds and ETFs are passively managed, they typically have lower turnover rates compared to actively managed funds. This means they don't buy and sell stocks as frequently, which can lead to fewer taxable events for investors. ETFs, in particular, have a unique structure that allows them to avoid triggering capital gains taxes when shares are bought and sold. Instead, they can create and redeem shares in kind with the underlying securities, which can result in fewer tax liabilities for investors. In short, index funds and ETFs tend to be more tax efficient than their actively managed counterparts, which can help you keep more of your hard-earned money. The truth about risks. Now, let's talk about the risks associated with index funds and ETFs. No investment is without risk, and it's crucial to be aware of the potential downsides. Market risk. Since index funds and ETFs track specific market indices, they are exposed to the ups and downs of the market. If the market experiences a downturn, your investments will likely follow suit. Tracking error. Although index funds and ETFs aim to replicate the performance of an index, there can be small differences between the fund's returns and the index returns, known as tracking error. This discrepancy can be due to management fees, differences in the composition of the fund's holdings compared to the index, or other factors. Liquidity risk. While most popular ETFs are highly liquid, some niche or less popular ETFs may have lower trading volumes, making it more difficult to buy or sell shares at your desired price. Understanding different types of index funds and ETFs. Before we wrap up, let's take a moment to explore the different types of index funds and ETFs available to investors. Knowing your options can help you make informed decisions when building your investment portfolio. Equity index funds and ETFs. These funds track stock market indices, such as the S&P 500 or the Dow Jones Industrial Average. They offer exposure to a diverse range of companies and sectors, allowing you to invest in the overall performance of the stock market. Bond index funds and ETFs. These funds track bond market indices, such as the Bloomberg Barclays U.S. Aggregate Bond Index. They provide exposure to various types of bonds, including government, corporate, and municipal bonds, and can offer a steady income stream and lower volatility compared to stocks. Sector-specific index funds and ETFs. These funds focus on specific sectors, such as technology, healthcare, or energy. They allow you to concentrate your investments in industries you believe have strong growth potential or that align with your interests and values. International index funds and ETFs. These funds offer exposure to non-US markets, such as the MSCI EAFE Index, which tracks stocks in developed markets outside of the United States. Investing in international funds can help you diversify your portfolio and benefit from growth in other countries. Factor-based index funds and ETFs. These funds target specific factors, such as value, growth, or momentum, to construct their portfolios. They offer an alternative to traditional market capitalization-weighted funds and can help you tilt your portfolio towards certain investment styles or risk profiles. How to get started with index funds and ETFs. Now that you have a better understanding of the different types of index funds and ETFs, you might be wondering how to get started. Here are some simple steps to help you on your journey. Assess your financial goals and risk tolerance. Before you begin investing, it's crucial to understand your investment objectives and risk tolerance. This will help you select the right index funds and ETFs that align with your needs and preferences. Research and compare funds. Once you've identified your goals, start researching different index funds and ETFs. Look for funds with low expense ratios, minimal tracking errors, and strong historical performance. Websites like Morningstar and Yahoo Finance can be useful resources for your research. Choose a brokerage or investment platform. To buy and sell index funds and ETFs, you'll need an account with a brokerage or an investment platform. Look for one with low trading fees, a user-friendly interface, and a wide selection of funds to choose from. Start investing. Once you've chosen your platform and opened an account, you're ready to start investing. Remember to diversify your portfolio and consider dollar-cost averaging, which involves investing a fixed amount at regular intervals to reduce the impact of market volatility. Closing thoughts. Investing in index funds and ETFs can be a powerful way to grow your wealth over time. By understanding the truth about their performance, tax efficiency, and risks, you can make informed decisions and create a well-rounded investment portfolio. The truth about index funds and ETFs is that they offer a low-cost, tax-efficient, and relatively low-risk way to invest in the market. While they may not be the perfect fit for every investor, their benefits, such as diversification and passive management, make them a compelling option for many. Remember, though, that investing always carries risks, and it's crucial to do your own research and consider your personal financial goals before diving in. And if you need help, don't hesitate to consult with a financial professional. Thank you for joining us today on the Wealth Wizards. If you found this information helpful, please give us a thumbs up, share this video, and leave a comment below with your thoughts or questions. And don't forget to subscribe and hit the bell icon to stay up to date with our latest content. We appreciate your support, and we're excited to have you as part of our community. And guess what? We've got more great content coming your way. In our next video, we'll be exploring the world of robo-advisors. Are they the future of investing, or just another financial fad? You won't want to miss this fascinating discussion on how technology is changing the investment landscape. So, stay tuned, and we'll see you in the next episode of The Investment Insider. Until then, keep learning, stay savvy, and continue building your financial future. Disclaimer: the information and opinions expressed in this YouTube video are for informational and educational purposes only and do not constitute financial, investment, or professional advice. The creator and/or host of this video is not a financial advisor or professional. The content presented should not be considered financial, investment, tax, legal, or other professional advice. Always consult a qualified financial professional before making any financial decisions. Thanks for watching Wealth Wizards. Please consider subscribing.